If you're looking for something that's going to be bullish, okay? If you're looking at something that's going to cause and be a catalyst for price to go higher using my concepts, what would that look like? Well, I chose to work with fair value gaps for a lengthy amount of time in the last year and a half, not because that PD array is the best. The point is this: knowing what makes the market go up, there has to be some underlying premise. What was the premise on the dollar index? This low swept it there. And then we want to look for a low risk entry to a market maker buy model. Oh. So what you're saying is anytime that the market enters into a buy program, that means it's going to remain bullish for a length of time until it trades and traverses to an opposing pool of liquidity. That's the technical term that you'll see in the book. Okay. What this is it's smart money reversal. Smart money reversal will always, this is for your notes now, okay, will always be a purge on liquidity, whether it be a market maker sell model, which would be the opposite of this high down to that low, coming all the way back up, traversing right back to that liquidity there. Now, you may not recognize this as a new student or even someone that's been with me for a little while. You may not see this as a market maker buy model, but that's exactly what it is. They don't have to look perfect textbook, but the mechanisms behind where price is going and why it's going to go there is still remaining constant, meaning that yes, there was a willingness for traders to go long here. Wonderful. Supply and demand, not a factor. Support and resistance, not a factor. Liquidity, absolutely the lifeblood of the marketplace. So you got to stop thinking about, where prices caused the last buying thrust or the spring lower. Okay. Forget all that Wyckoff stuff. Okay. Forget all of it. It's archaic. It's simplified, simple stuff. It's so easy. All you gotta do is read it one time and you know everything about it. But now graduate from that. Graduate from it. Look at the market a little bit deeper because there's a whole lot more going on that are very, very precise, very specific things that repeat on a time-based delivery. When market went down below that low here, what was below that low? What would be resting below that low right here? In terms of liquidity, it would be sell stops, pending orders for two things. First, those individuals that went long or anywhere in here, they're not going to feel safe by putting a stop loss that's real short. They're going to want to go back to this low here because they're going to see that that is what? Well, that was very strong support because look how the market reacted. Yes, I'll give you that. It reacted like that. Wonderful. But I'm not looking at that as I'm gonna wait till it goes down here and touches this and go long. No, I want to see it go below it. Because what that will do, it will give me immediate feedback on whether or not this was a raid or if it's going to continue going lower. So it gives you a case study. It gives you an opportunity, like a laboratory experiment for the people that went through biology class or university. Remember that? You had to go through these labs. Well, this is a lab experiment every single time you're watching an old high and old low on any time frame. Why do I teach in the lower time frames? Because there's a lot of opportunity for you to do the things I teach and study. And you'll find all the evidence that this stuff works perfectly in your own hands. You don't need me making videos and recording things. So the market probes below that here. Let me move this up a little bit. So it moves below that low there. So it opened. Look how this candle formed. And these are daily candlesticks behind you up here, upper left-hand corner. And so when the market's reaching below an old low like that, I want to see it travel below it. And by opening above that low being here, this candlestick opened right there, right there. So the opening on that candlestick's price is 96.617. And then at that moment, it starts dropping down to that low. Now, support and resistance folks would be like, okay, it's going to go up right there and want to go long there. And they may elect to go long like that. But I'm not doing that. That's why I don't trade support and resistance. What I'm looking for is, does it trade down below it? Why is that important to me? Because number one, everything that causes the market to rally high and low is always on the basis of a market maker sell or market maker buy model. Every fluctuation in price action could be broken down fractally to that very premise right there. Now, it need not be understood at the beginning of your learning exactly what that means. It just means that you're going to grow in your understanding about what that means if you're studying with me. Regardless of what you trade as a model, your entry, your silver bullet, your model 2022, for instance, model 2022, that is low risk entry. That's the part of the market maker sell model or buy model that you're trading. You may not have ever identified it as such, but that's exactly what that is. Turtle soup, that's the smart money reversal. Maybe you've never known that. Maybe you never identified it as such, but that's what it is. Second stage reaccumulation or second stage redistribution, which is the unicorn of the models, that is the biggest, most explosive, sustained price run that trades to the opposing liquidity of a market maker sell or market maker buy model. Now, for someone that's new, that sounds like a whole lot of mumbo jumbo, but I'll explain it in a moment, okay? But those continuations are simply silver bullet premises applied to that time frame that you're seeing the market maker model on. So, by having the expectation and anticipating that price will drop down, let's break it down into even a smaller scale. And what I'm saying here is not just applicable to the dollar index, but I'm telling you what you can do with this information. You can scale this to any measure that you want it. You want to be a higher time frame chart trader? You don't have time. You can't be in front of the charts because you have a job. You're in university. Your lifestyle where you live geographically, you can't be awake at that time. Okay, these are real world problems. Now, I don't have an answer for everything, and some of you may be required to make significant changes in your personal life. And that, unfortunately, is going to be a decision factor for you. And I'm going to leave it to you to determine that. You don't have a way to get in and trade intraday. Okay, this candlestick opens right there on that day. So, right away, you know that there's a strong potential that the market's going to traverse from that opening price to that low. Okay, why? Because there's liquidity and it's so close. It's called close proximity. This opening price to that candlestick's low, close proximity. So if you were a day trader, a scalper, what do you think might be beneficial for you in this condition right here? You know it's going to act like a magnet and draw you down to that liquidity because there's orders below that low. What kind of orders? Sell side liquidity. So that sell side liquidity is doing two things. Number one, it's protecting, quote unquote, the long holders with their stop loss below that low. Who would do that? There's lots of traders that do that. There's lots of traders that do that. But maybe there are individuals see that low and they think the dollar index is going to go lower. They see all the things that's going on in the Trump administration. They see all the things, the bad decisions being made on both sides. And maybe they're bearish on dollar. And they think once it goes below that low, they want to sell short on a breakout. Breakout artists selling short on a stop. So there's sell stops protecting long holders or sell stop entry as a mode of entering going short. So you can be a buyer or seller on a stop. That means it has to trade to your price. Just like if you're long and you had a sell stop below the marketplace at, say, for instance, 50 cents, whatever that would be, whatever the instrument would be, say 50 cents is your sell stop. As soon as it trades to at 50 cents, it's going to activate that order to do what? Be a market order to sell at market. Then there's limit orders where you can buy or sell on a limit. That means it has to trade to your price or better. So in other words, what would that look like? If you were short already, or if you're going short at the open, reaching down to that low, this low price comes in at 96.377. So if you put a limit order to sell, I'm sorry, to buy it back, you would be putting an order at 96.376 theoretically. Me personally, I would put it right at that low. because I want to make sure that even if it just touches one tick below it, chances are I'm probably going to get that fill. And you can see it doesn't spend too much time down there. So as a day trader, in your Forex trader, when you see the daily chart, which is again what I teach many times, you want to look for these pools of liquidity, these draws on liquidity on the daily chart in the direction that the monthly and weekly instigate. Where is it really moving? Where's the strongest tide pulling us on that monthly and weekly chart? And there isn't a whole lot of changing of that tide. It stays in place for a while. But it's hard for you to stay on that side intraday because you're seeing 50 handle runs out of nowhere. Where'd that come from? Oh, I'm probably on the wrong side. Let me change my long-term bias to this now. What does it matter on a 1 minute chart, 15-second chart, 5 minute chart, 15-minute chart? What does it matter if it rallies up real strong like that when your higher time frame bias is bullish or bearish? That's infancy. That's immaturity as a trader because you're allowing short-term fluctuations and volatility to screw up your perspective and you get misaligned and you abandon this idea that's based on higher time frame premise and you get yourself in all kinds of potluck trouble. As a Forex trader, the day that it opened up right here on the dollar index, you know that what's the dollar going to do? Strong likelihood that it's going to traverse intraday during this daily candle. It's going to trade down to that low. And the way I teach, it's going to reach below that low because there's liquidity below it. Now, as a scalper, as an intraday trader, for Forex, if dollar's going down, if it's going down to that low, that means you have short-term scalps that you can go long on euro and pound dollar, Aussie dollar. Anything with the dollar index second in the name of the pair. That's a buy scalp because dollar's going to drop to that low. So right there, all of a sudden, now you have a real quick way of being able to go back and study things on your own charts. This same premise, even though we're looking at it on a daily chart, upper left-hand corner, the daily chart time frame. If you see this low here, say it was a hourly chart that we're looking at, not a daily chart. Okay. Same premise here. The hourly chart, if it opened, say this is an hourly chart, not a daily chart. Okay. And we're real close to that low. The hourly candlestick would be opening here. You know that it's likely to do what? Strong likelihood that it's going to want to drop down to that low. It matters not what time frame you're trading on. It's the same idea, same thing being applied. So if you're a scalper, if you're an intraday trader, if you're a swing trader, if you're a position trader, I'm an off intraday chart trader. I can't do the things that ICT is doing on a 1 minute chart. I need a mechanism to do this without looking at intraday charts. I'm going to come back to that. Just relax. But you can see how these ideas can be beneficial to you. And that's why I teach that if you use an hourly candlestick, like a daily chart, you'll never run out of setups. It's every single hour there's something to do. Now I want to make sure I remind you that that is not an invitation to overtrade. And some of you that are very short on discipline just took that and said, he just said, I'm going to trade every hour and make money. Where's my funded account? That's it. Give me a code. Trades by Matt. TBM code. TBM. I'm going to get in there. I'm going to use this information right now. I don't want you to feel like you got to trade every hour. Okay. But the very, very astute, apt student of smart money concepts will learn over time that they can take a trade every 60 minutes. Now, think about what we've done here. Close proximity to liquidity on a daily chart. That means intraday, the market's going to trade down to that low. If you're using intermarket relationships and it's dollar index that you're doing the analysis on, it's likely to do something like this. That means that the Forex pairs that have the dollar index in the second name, for instance, the dollar's going to go down. Should be charging you money for this, man. I could be paying my bills. I could be getting out of debt. What is debt? What does that even mean? What does that mean, debt? I don't know. I haven't been there for a while. So pound dollar, euro dollar, Aussie dollar. So that means the pairs that have the US dollar second in its name, when it's opening here on the dollar, and it's going to drop down into that low and below it. Okay. When it does that, these types of currencies in Forex are going to go up until the liquidity below that low here is taken. Then the easiest low hanging fruit objective for you is to sell your euro long, pound dollar long, Aussie dollar long. Now, for currency pairs that have the dollar index in the front of the name, that's USD, JPY. I hate that pair. I hate the yen. Dollar Swissy. Okay. And they will do the same thing. They will mirror what the dollar index will do. So there'll be some kind of a low that they're reaching for too. But you want to make sure, here's this very important. Please don't miss this point, okay? When you're trading with positive correlated forex pairs with the dollar index, and your analysis is being framed on the dollar index all the time in forex. Always. If you're not trading with the dollar-based idea, you are trading blind. I promise you, you are not finding the success that you could have if you're avoiding this part. This part here is important for currency trading, because what your opinion is about the dollar index, until it's completely gone, it's the daddy. Okay, so we're in close proximity of this low for dollar. It's going to likely draw down to that. Dollar yen, dollar Swissy, they're going to drop too. But the low here's the kicker. The low that may be also something that you're aiming for, relatively the same time that this is being formed. So in other words, on Tuesday, July 1st of 2025, there might be a low on the dollar yen or the dollar Swissy, comparably at that low, but it may not take that low. How could that possibly happen? If the dollar's going to take its low, why wouldn't the dollar yen and the dollar Swissy take its low? SMT. Now, right there, that has cleared a whole lot of cobwebs for some of you out there. Okay, because you think everything should be 1, 2, 3, ABC. The rules never deviate. There's never any kind of you know, departure from what you think in your infancy and learning initially versus what the realities in the marketplace is. So having the analysis anchored to the dollar, that means when this low is taken there, that is when you close your short on dollar yen, dollars Swissy, or any pair that starts with the dollar in the front of the name of the pair. Remember, these up here with the dollar index to the right, there's a second name in the title of the pair. They're going to be moving the opposite direction. Okay, so very, very important. You have to keep in perspective what the dollar's doing, because if this thing's going to move, it's going to affect the currency pairs that you're trading. And SMT, which is a divergence. And visually, let me do it this way. That's essentially what we're expecting in dollar. That low, this low piercing that low. That's the old low. This is the low we anticipate forming below the previous one. That's this visually here. But we may see comparably, we may see a low in the dollar yen, and it's getting real close to it, but it may not go all the way below. It might go right just above it and then pull away. And then you have the dollar Swissy. It might agree and go that slightly lower low. But what do we have? We have a divergence in positively correlated currencies. Dollar index based with the dollar in the front of the name, with the dollar index itself that we're showing here in chart form. This is what we anticipate in dollar. This is the reality. With yen, it says, no, I'm not going to go lower. And this here does go lower. If this happens, that could be indicative of a shift in internals that's going to support or cause a larger magnitude reversal mindset on the dollar index, because Big money, remember I was telling you earlier at the beginning of this live stream, is that they don't have the benefit of going into the marketplace on a very small short-term time frame. They have to move throughout blocks of price action that they have to implement over time. It can't be their full positions placed on right now because they're trying to hide what it is they're doing. And they also have to use the available liquidity that's available in the marketplace. There isn't always the amount of liquidity at that tick in the next 1 minute candlestick time frame. All the price action that took place in that 1 minute or 5 minute candle isn't enough for all of these banks globally to shove all their orders in on that one candlestick. Okay, so that's not what they're doing. They're not trading on one candlestick entry and that's it, and then we're done. But what they're doing is they're accumulating the sell stops below here, and then they're buying more at that opening price. And that's where you, working class hero, that's you, Mr. I can't be in front of the charts intraday. Hang on one second. My puppy's right next to me. She's snoring. It's distracting me. Hey, Scotty, listen. I understand you're relaxing and living the finer things in life, okay, but you have to relax and stop snoring like that. I'm live here. I can't edit all that stuff out. She understood everything I said. Trust me. I'm the one that feeds her. So the opening price here, when price goes down below that, if you're a working class hero, okay, let me get this stuff off here. If you're a working class hero type trader or in the process of becoming one, you don't need an intraday chart. How can I take this information and use it? Okay. You can have the same expectation and anticipate that they're going to drop from that opening price down here. When does the dollar index open? That's very simple. That's a time that never changes. It's simple. That time, whether you have a job or not, your phone has an alarm clock, right? It should. You probably use it to wake up, to get ready to go to work. You set it to see what time the dollar index or whatever that pair or whatever, I'm sorry, not pair, that market opening price is anchored to. If you're going to be using um, index futures, you're going to have to decide whether or not you're going to use settlement price or non settlement price. You have to determine those things. I tell you always refer to both. And back testing and studying, it'll tell you which one you want to use if you're going to use this approach to doing it, which is non intraday based. But now, what do I do with this information, Michael? How could I use this to paper trading and get better? Notice I snuck that in there real quick, okay? Because I'm not telling you to do this with real money. I'm not someone that is positioned and licensed and certified to be a trade advisor. I'm not a CTA. I'm not a financial provider of information. I don't have that, I guess, authority to do that. So we're talking hypothetically. We're talking about reading price action and studying it and getting used to seeing what it's doing over time. But if you, where are we at here? If you anticipate that price opening on that candle and you want to be a participant in it, you get the opening price, see when we're in close proximity, like as soon as they close here like that, okay, wonderful. Then wait for the new candle for the daily chart to open up, get the opening price. Then you know that it's likely to traverse and go down to that low, and you want to see it trade below it. As soon as it does that, as soon as it gives you this information, you already know that you can have a buy stop. Okay. You don't have to be in front of your charts. It's on autopilot, complete and utterly nothing to worry about. You can apply this to index futures. You can try to trade it with Forex pairs. You can do it with stocks. You can do it with commodities, bonds. I'm not going to say anything with crypto. Okay. I know you see me doing some things with crypto And that's just simply because I've been inundated with people. Please, 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 please. Once in a while, I'll share my ideas, okay? But Bitcoin's going to zero. So stop bothering me. Okay. Just leave me alone. So the idea is that once it does this, you're not in front of the charts when it's doing this. You don't need to be. As soon as it comes right back up and hits that opening price again, if your premise is correct, if you are right about the ideas that you think that it's going to go down here and take the liquidity and then start the run on a smart money reversal basis, are you getting long down here at the low on turtle soup? Nope. Do you need it? Nope. Because your idea is it's going to go up to, now here's the test for you guys that have been studying through my private mentorship. Where is the draw after smart money reversal? It's a trick question now. Pause the video if you don't want to know. If you're watching it in real time here, I don't have the luxury of doing that, but you're going to be forced into the answer right now. So what you do is you want to take your high down to the low that formed intraday, and it comes back to that opening price. As soon as it comes back to the opening price and trades one tick above it, you're immediately inside of a new buy program. So this is kind of like a little play on words with order block theory. It's the reverse. Yeah, how about that? Wonderful. You'll get more information in the book. Don't worry. Don't buy the book. Let it go out into the marketplace. Trust me. Trust me when I tell you that. Okay. It's not meant for me to make money on the books. It's just meant for me to put it in written format. This opening price on that candlestick, as soon as it hits that, you can be long. But inside of this, where we at here? Here we have the high, and this would be the original consolidation, or where the draw would be on a perfect market maker buy model. Market's going to go up here. But in your infancy as a developing smart money concept trader, you don't hold to that idea all the time. You have to have a low hanging fruit objective. What would that be? 3/4 of the move, okay, or optimal trade entry. Because if you studied with me and you went through private mentorship, you know that a market maker buy model and a market maker sell model does not have to go all the way back to the original consolidation or opposing liquidity. That's just the best case scenario. Now, best case scenarios are just simply that, a scenario. They're not an absolute. They're not a panacea. They're not a be all end all. It's going to only happen this way, like you think it should as a new trader. New traders think that way. It has to work like this all the time, or I don't want nothing to do with it. Go do something else, because that's not what the market's going to do. Okay. I promise you, in the first 3 years of your trading, you're going to find out that you are probably 90% wrong about what you think is going to happen. And any money you make in the first 3 years is just happenstance. You aren't really equipped to be consistently profitable. Even if you are profitable, the first 3 years you're floundering. You're going to discover so many things past that third year. So if you're in a hurry to get profitable in the first couple months or the first year, settle down. This is a lifestyle. It is not a lottery win mentality where you go and now you suddenly have to make money all the time. You're going to learn so much about yourself, and it's good that it's this way because you're going to be much more mature as a trader. What I mean by not having to go all the way back from this low being taken out for the purposes of liquidity, but we anticipate it being a smart money reversal to take us up higher. Now, let me remind you, go back and listen to what I said all during this time. I was marking out all the things in here and then eventually in here and eventually up there. I was giving you mile markers. I was not bearish dollar at all. At all. It never happened. My videos have never been edited, and I haven't deleted anything. They're still up there. Low-hanging fruit objective would be reaching up to 70.5, which is the sweet spot or optimal trade entry between the 68, 79% retracement levels. That was the flagship pattern that I started teaching. But its foundation finds its way in every facet of my trading. What do you mean by that? For a different discussion. But here, this is low-hanging fruit. That means that this is all you would require getting up to from that low. You don't need it to go up to here, but it still can. Now, working class hero. As soon as it opens and it trades down below here, okay, what you can do is put a good till cancel buy order in the form of a buy stop. As soon as that low gets taken out, you put a good till canceled buy stop in your paper trading account. Okay. When it trades there, then you use that low as your stop, or maybe a little bit below it because you just want to have no concern about it. Once it fills, your objective is to aim for that 70.5 level. That's your working class hero model. You're trading the same things that we're trading with intraday charts. You're using very specific criteria. You're not willy-nillying and worrying about what's fair value gap to buy. You're not worried about what order block to buy. It's a very static price entry. It's very, very generic, and it works. And yes, Virginia, I've made lots with it. Okay, so this model can be used on any time frame. Don't think that this is the only way to use this because it's a working class hero and this is how you use it on a daily chart. You can do this on 1-minute charts. You can do it on a 15-second chart, a 5-second chart. Everything you see here. What argument can you make against this whole price action, all these fluctuations? What's the argument that can be made that it would or wouldn't work in any other time frame? It's just your ignorance that would be in the way. It just proves you haven't studied all the time frames that I talk about. And there isn't one perfect time frame. What's the time frame you're going to trade right now? There's no perfect time frame. Price is price. It's going to exist on every time frame. It may not be trading in the PD array that you're looking to trade in the time frame you're watching at that moment, but eventually it will. And then that's the actionable point of entry on that given time frame. But there's all kinds of entries going on all day long. And to see these people sit on live streams and stare at price action, shaking their head, moaning, "Oh, I don't see anything I like," or "Oh, I don't have anything here today." Why? Why don't you? Because if you understand what I'm teaching is a universal model. You can go into any time frame and frame out something that is actionable. Every day is an opportunity for you to work with these candlesticks on lower time frames and develop a skill set that once you acquire it on the lower time frames, you can place that same model in everything. It's a cookie cutter. Okay. The market profitability that's available to everyone is the dough. No pun intended. You want to make dough, right? Well, this baker never runs out of yeast. I can take that cookie cutter that I just gave you here. I can press that into any time frame in any market and ravage it. I could have gingerbread cookies, chocolate chip cookies, snickerdoodles, Christmas cookies, Halloween cookies, whatever holiday. I can make my own holiday, ICT day. Okay. I can press this into any market and cut out profitability. That's the power that's in your hands. You may not have observed it or understood it to this point, but I'm trying right now, proverbially, reaching into this microphone, into your screen. I'm grabbing you by your lapels and pulling you real tight. My nose is touching yours. Listen, this is yours. It's yours. All you have to do is start believing it. You have to work with it, get accustomed to it. Every time frame is tradable. Every time frame. These yahoos, whether they come from Goldman Sachs or anywhere else, okay? PhD, piled higher and deeper after their name. Oh, but I won this time in this competition. Whatever, come out here and do it live. Call every single tick live. Call it. I don't care about pewter trophies. I got millions of dollars in the bank. Millions of dollars in the bank. That pewter statue doesn't go do ain't gonna do anything for me. I could write books and sell books and go out and start a mentorship and start making millions of dollars every single week without a Robin's cup. I don't need all that stuff. These people that win these competitions, they still can't sell their stuff. I'm out here paper trading in front of you, and you're all watching my live streams. You're all watching my videos, taking notes. Why? Because my stuff resonates with you, whether you like me or not. I don't care. But you know what I'm showing is the truth. Okay. We're going to have a huge paradigm shift right here. We don't demand that it goes coast to coast from down here where deep sell side is all the way back up to the buy side, which I told you it could potentially reach for, but I told you specifically we're going to aim inside this inefficiency. Go back and watch the videos from this day all the way through whenever I was doing the commentary, but it basically stopped before I went away on the first week of October. I think I probably did 2 videos, maybe 3 videos. I think. I don't know. It wasn't very many because I've been out running around rambling. But that's where I took your focus in here on this inefficiency. Go back and look at the recordings. Why did I focus there and didn't press hard about that one? Because I just taught you practicing what I preach. The easiest draw, low hanging fruit, if you're trading a market maker buy model, is 70.5 of the range. What is the range? What is the dealing range? How are you framing your market model? Market maker buy model or sell model. Here's the high, and that's the low it's going to trade down to. Why? It's going to go there. So from that low, once it trades there or through it, when it creates that low and comes back up to that candlestick that trades down to the low, that opening price is very, very crucial. Very crucial. It is a PDA rate. I'm not going to reveal its name, but that function frames the whole basis of returning back inside the range, and that range is this. High, down to low. That's the range. Now, when I was on Baby Pips, I did a I don't recall if it was a live stream. Honestly, I want to believe it was live stream, but I don't think it was. But either way, I did a lecture called "Trading Inside the Range," and this is an amplification of that very lecture. And I don't need it to trade outside of the range high here to be profitable. I mean, what happens if you just traded to this high here for a minor buy side? Why is it minor buy side? Why'd you call it that, Michael? Because it's not even at 70.5 of the full range that's here from here down to there. That's a dealing range. The market has dealt in between here. So if it goes back up inside that range, you're doing the same thing. You're dealing inside that range. So you're trading inside that range. That means you need to know what you're looking for. Where is there an easy draw on liquidity? Okay. If you're using this model here, and you're very, very new and you're scared, you have a whole lot of anxiety, you can't stop looking at your phone while you're at work, don't get in trouble at work. I've people email me, tell me they lost their job because they were watching videos, my videos at work. Come on now. I told you don't do that. Don't get in trouble. You need your paycheck right now. Eventually you won't, but you need it right now. So don't lose your job over this, okay? But if you're doing it and you're using this model, 70.5 is way up here, right at that high, conveniently. Okay. So what would be easy objective, low hanging fruit objective for you if you're trying to grow in that and you don't want to wrestle through all the anxieties that's going to come? Well, what's the first swing high from that low? Go back. Bang, right there. So that would be your draw to initially. So if you're trying to work out the effects of holding on to trade ideas or learning how to hold to a trade, but you want to graduate to it, casually and without a lot of pressure on you, use this approach. Okay. And also, you can blend it with purge and revert. Thought I forgot about that, didn't you? Where it runs down, takes out the low, which is a smart money reversal premise. Okay. A premise is not a narrative. Premise is it's probably going to do this. That means what? Go up or down once it goes to that level. That's not bias. That's not narrative. Narrative is price is going to go down below that low because there's sell side. That's narrative. It's going to go down there. And then now you start using a bias. Once it does that, I'm bullish. You see the difference between all those things? They're not the same thing. And when I see these 20-year-olds talking using my buzzwords that supposedly were rebranded from somewhere else, why don't you use the old stuff? If all my stuff is rebranded and you're constantly telling your people, which are really surrogate students of my own, they're mine, they're my students, they're not you. You're just getting a commission because you're using my name. But I'm teaching your students, okay? Eventually, they're all coming to me because they find out that you're hiding my name and you're trying to say that you discovered this on your own in these third world countries. They're eventually finding me. They're finding me in Iran. They're finding me in Iraq. They're finding me in Pakistan. They're finding me in China. They're finding me in Indonesia. They're finding me, folks. You're not going to hide very long. But I'm worldwide now, and I'm still for free. And I'm here today doing it for free still. And they're learning what you can't teach them. These ideas, these premises, okay, are useful to a certain degree and then they stop. Then you have to rely on further understanding. So bias, narrative, they're not the same. Premise, not the same. It's going to go up to go down. It's going to go down to go up. That's a premise. Alrighty, so purge and revert. Purge and revert is when we take a low out like that. If you're reaching down below old low for liquidity purposes, now this is a very, very powerful concept, but it doesn't require a whole lot of movement. There's not a lot of moving parts either. Okay, so as soon as the low is taken, you go back 3 days. 1, 2, 3. That high right there. That's the liquidity it's going to draw to. Easy, 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 easy peasy lemon squeezy. That's it. That's your model. You don't even need it to go back to this high. You don't need it to go back to this high, that high, that high. 70.5 level of that range. And for those that don't know what I'm talking about, again, let me throw it right back up on the chart. And then sweet spot optimal trading street, 70.5. So that, look at that high, right, sitting right there. It's almost like it knew it was going to create that, right? See, that's what I started seeing. These things, that low didn't even exist yet, but this so happens to be right at the 70.5 level. And you're going to tell me there's no algorithm that's going to know in advance how far it's going to run before it goes there? Come on. Come on, folks.